Hi, I'm Mark and welcome to Remarkable Reverse Mortgage. This video and blog are entitled Dave Ramsey, the Reverse Mortgage 800-Pound Gorilla. I think Dave Ramsey is a national treasure. We have followed and benefited from his wisdom over the years. But if I agreed with everything he says about reverse mortgages, I couldn't be in this business. In fact, everything he says about reverse mortgages is negative. Frankly, it's very frightening. So with that understood, let's take a look at what I consider to be deal maker or deal breaker issues. Now, this material is resourced from What is a Reverse Mortgage? An article written by Dave Ramsey, published on RamseySolutions.com. So let's start with number one, deal maker or breaker. Ramsey writes, a reverse mortgage is nothing more than a predatory program designed to take advantage of you. Well, the reverse mortgage program was designed by the U.S. government to help seniors, especially those of modest means, stay in their homes. And in the past 12 plus years, I've been originating loans. The HECM program has evolved to the specific benefit of seniors. Here are two advancements in particular. First, the addition of the financial assessment of a borrower's ability to meet the terms of the loan. This assessment gives us the ability to look at the credit and payment histories of potential borrowers. That helps the responsible and hinders the less responsible borrowers. Second, there's a limit on the initial draw amount or the cash at closing. Since 2017, the whole program has become far more balanced and sensible. In fact, I've had very few borrowers take a maximum draw of cash at closing. Most of my borrowers don't actively use their line of credit. They tend to set it and forget it. FHA insures the HECM reverse mortgage. You pay an upfront mortgage insurance premium. This mortgage insurance guarantees the terms of the loan for the benefit of the homeowner, not for FHA or for the lender. The mortgage insurance on a traditional or forward FHA mortgage or a conforming mortgage insures the lender. I call that protection, not perdition. It's a deal maker to me. You decide what you think. Number two, deal maker or breaker. Ramsey writes, homeowners who take out a reverse mortgage put up their homes as collateral for the loan. Can we talk for a second about how risky that is? It's a good question. How risky is that? If you have a traditional or forward mortgage, your home, your creditworthiness, paying the property taxes, and homeowner's insurance are collateral for the loan. Your timely payments are a requirement of the terms of that loan. If you get far enough behind, the very real risk is foreclosure. And there are very few viable options at your disposal. I think that is risky for people on fixed incomes who have multiple years of mortgage payments laid out ahead of them. With a reverse mortgage, your home and the FHA insurance are the collateral for your loan. You are not required to make a payment, so you can't miss a payment, and you are still required to pay your taxes and homeowner's insurance. The same is true of any type of mortgage financing. If you don't keep your taxes and homeowner's insurance current, if you neglect those requirements, there is a risk you could lose your home. If you have a reverse mortgage and you can't meet your requirements because of a hardship, a health crisis, loss of income, or the death of a spouse, you have options. You can communicate your situation with your loan servicer to access those options. You don't need to ignore or fear your trouble or your problems. Reverse lenders understand that things can happen to senior borrowers. I have seen them exercise extreme compassion to keep reverse mortgage borrowers in their homes. That's far less risky than trying to remedy a mortgage shortfall. Here's a note. Even if your home is paid off, you still need to pay your property taxes. Homeowners insurance may be at your discretion, but in my opinion, it's never a good idea to leave your home unprotected. That's a deal maker in my book. You decide what you think. Number 3, deal maker or breaker. Mr. Ramsey writes, you could leave your family a huge mess. Well, if you do bite the dust before paying off your loan, your family will have 2 options. Pay back the entire amount you owe or give up your home to the bank. Is that really the sort of situation you want to leave your family in when you die? Is that what you want your legacy to be? Let's look at the first option. Pay back the amount you owe. For one thing, your family doesn't owe the balance of your reverse mortgage. They don't have to come up with the money that may be owed in your loan balance. Even your estate doesn't owe the balance of your reverse mortgage. So who does? Well, your home and your rich Uncle Sam. By that I mean the FHA mortgage insurance you paid for. They pay, not the family or the estate, if you owe more than your home is worth. Second option, give up your home to the bank. If your home is underwater, if more is owed than it's worth, you give the keys to FHA and they take it from there. You can never owe more than the net proceeds of the sale of your home. And if your home still has equity, and most will, your estate can sell the property, pay off the loan balance, and distribute the difference according to your wishes. Or if your estate decides to pay off the loan and keep your home, you can do that according to your estate plan. That's not much of a mess if you don't leave one. That's a deal maker to me. You decide what you think. Number 4, deal maker or breaker. This is the Ramsey solution. He writes, literally anything would be better than taking out a reverse mortgage. Okay, maybe not robbing a bank or committing tax fraud, but seriously, if you're strapped for cash, there are better options than these horrible programs. Let's look at his solutions. Number 1, get a job. Keep working and max out your retirement plans. What if that ship has already sailed? Number 2, sell your house and downsize. Pay cash for something smaller. Only you can decide if number 1 is a viable option for you. But since we live in Colorado, let's discuss option number 2, which is sell, downsize, and pay cash for a smaller home. The reality in our state is this: suitable homes are scarce. Competition for those right-size homes is fierce, and paying cash for those homes is common and not the exception. Also, qualifying for a new forward mortgage is difficult on retirement income, especially if you were having a tough time making ends meet before. In my experience, people do reverse mortgages because they want to stay in their home, not move to another home. When we talk about options, everything is on the table, but I never forget whose table I'm sitting at. My average borrower is about 72 years old, no longer in the workforce, with a mortgage of about $150,000. And after looking at all of the above, a reverse mortgage looks pretty good to them. If you have a better option, take it. If not, to me, that's a deal maker. You decide. Here's the bottom line: deal maker or breaker. If you accept the Ramsey reverse mortgage premise, which is reverse mortgages are major ripoffs, that is a deal breaker for you, regardless of any other perspective. Try one of his solutions, and I wish you all the best. And if you are open to other perspectives, including ours, that is a deal maker. I'd say over the years, about 50% of the people I've done loans with have asked me, hey, what about what Dave Ramsey says? Well, those conversations were the basis of this blog and this video. I'm Mark with Remarkable Reverse Mortgage. Thanks for stopping, looking, and listening. Remember, we do Colorado reverse mortgages.